Well, as of recording this video, we are wrapping up the tax season, it being April as of right now. And I thought this would be a really good time to talk about something that a lot of people get wrong when it comes to understanding tax rates. And specifically, what I'm referring to is effective tax rate versus marginal tax rate. So let's take a moment and we're going to jump into this. And I'm going to also show you how you can apply this information to your own financial planning as you are planning for your retirement that's coming up. So let's just jump in. Effective tax rate. I like to think of it as kind of like the average rate that you would pay for every dollar of taxable income that you claim on your tax return. What percentage of that went to the federal government? Okay. Now, the way you calculate this is you take a figure called the total tax. That's the total tax that you owe, and you divide that by taxable income. And then that's going to give you a percentage. Now, both of these pieces of information, total tax and taxable income, can be found on your Form 1040. And if you've just recently had your taxes completed by your accountant, you probably have them somewhat handy. You could pop it open, look at your 1040. Total tax is usually found like on the second page of Form 1040, and taxable income is usually found at the bottom of the first page of Form 1040. You just take those two pieces of information and calculate it so you understand how much of every taxable dollar that you have coming in is going to the government. So let's just use like a really simple example. Let's say that your total tax for the year was $10,000, and let's say your taxable income was $100,000. Well, that means your effective tax rate was 10%. Okay, so that's what effective tax rate is. Now, let's jump over and let's talk a little bit about marginal tax rate. Marginal tax rate is almost always going to be different than your effective tax rate because we live under a tax system that has progressive taxation, which means different bands of income that you earn are taxed at higher rates the higher up your earning goes. Now, marginal tax rates, those bands, those brackets as we call them, they are adjusted every year for inflation. So as inflation goes up, they scoot those bands up a little bit higher as well. And they're also different based on your filing status. So a couple may be married filing jointly. They'll have their own marginal tax rate brackets. Another person may file single, or you might see somebody that's married filing separately. They'll have a different one. Or you may see somebody that's a head of household. They'll have their own marginal tax brackets. Now, let's just use an example here, and I'm going to use, just because I have it sitting right here in front of me, I'm going to use the example of married filing jointly, and we're just going to use figures from 2023. All right. And just so you know, none of this is tax advice or anything like that. Just try to teach the concepts to you. So the way marginal tax rates would work in this scenario for a married filing jointly would be that the first 22,000 of income, that taxable income for this couple, would be taxed at 10%. Then from 22,000 up to, we're going to round this down to 89,000. It's just a rounding it down rough figure. It's 89,450 if you want to know exactly, but that's taxed at 12%. And then we're going to do one more bracket. We'll go up to say 190, and I'm rounding that also. And that's taxed at 22%. Okay, so if we look at this example over here before of $100,000 in taxable income, well, that would fall between these two figures. So that couple would be in the 22% tax bracket. Now, that doesn't mean that they're going to pay 22% on the entire 100,000. They're not, because the first 22,000 is only taxed at 10%. The 2022 through 89,000 was taxed at 12%. And that remainder that topped them off, that took them up from about 89,000 up to 100, that's about $11,000. only it was taxed at 22%. So the tax bracket of 22% for marginal tax rate is higher than the effective tax rate. And that's something we can kind of take effective tax rates that we can learn. They are typically always going to be less than marginal tax rates because we have a progressive taxation system. Now, what does this mean for you and how you're going to help yourself planning for your retirement or talking to your accountant or your advisor? Well, one thing that we can use effective tax rate for, I like to think of it as keeping score, just to understand what percentage of my taxable income, what percentage of that is actually going to the federal government that I owe in taxes. And, are there ways to lower that, things like that? It's a good keeping score figure. But when it comes to actually doing some tax planning, marginal tax rates are going to come in a lot handier for that. And here's what I mean by that. So let's just use a really simple example. Let's say you have an IRA, a traditional IRA, and you're thinking about converting 10,000 of it to a Roth IRA. Well, when you convert 10,000 or do any type of a Roth conversion, you essentially have to claim that as income. And that means it's going to be in one of these tax brackets. So let's just presume that in this example, you had income that puts you right at the edge of the 12% bracket. So around $89,000 in taxable income, that's right where you are. And if you decide to claim any more income by doing this Roth conversion, where you kind of essentially pay Uncle Sam and get him off your back so that you put this money into a tax-free Roth, any amount of that's going to fall in this example, let's say the 22% bracket. Well, if you understand that that's where your marginal bracket is going to be when you're doing this conversion before December 31st passes, then you can have a pretty good idea of what it's going to cost you. So $10,000, and if you are in that 22% bracket, just multiply it by that, and you'll see that if that was the case, it would cost about $2,200 to do that Roth conversion. And that's where, if you understand this information, you can then say, is it worth it to me to pay $2,200 to forever have the tax paid and put it into the Roth IRA and let it all grow tax-free at that point? Or is it better to just let it sit in the traditional IRA and not pay this money? You may be in a situation where you say, you know what, next year my income's going to be a lot lower and I'm actually going to fall well within this 12% bracket. And I could do that conversion next year at 12%. And if I did that, I would only pay $1,200 for the exact same Roth conversion. So that's where you have to start thinking about things like that. But it all starts with understanding what your marginal tax rate is. And it also helps in a case like this that if you did decide to do, something like just a plain vanilla Roth conversion, it helps you to understand how much in extra estimated tax should I pay during the year in order to cover this, so that when April 15th of the upcoming next year comes along, I'm not hit with this unexpected tax bill from a Roth conversion I may have done in July and I completely forgot about it. Okay. So that is the difference between marginal tax rates and effective tax rates, and how you would apply that to your own planning as you are planning for your retirement, trying to minimize taxes long term. Well, I hope that helps. And if you need any additional retirement planning resources, feel free to head over to retirementplanningmadeeasy.com. You can download a copy of our essential step-by-step retirement guide that's going to give you even further tips to help you out on your retirement planning journey. I will see you guys on the next video. Thanks.